Welcome to a special edition of Currency Exchange, brought to you by NatWest. My name's Tim Phillips. I'm on temporary assignment from my usual gig at TradeLinks, but the rest of the usual Currency Exchange team are here, and I'm going to be asking them about what's going to happen next year, 2026. And then 12 months from now, we can all get back together and think, did I really say that? Hello to Eimear Daly, emerging market micro-strategist. Hello, Eimear.
Hey.
And hello to Paul Robson, head of G10 FX strategy for Eimear.
Hi, I can't believe it's been a year since we recorded the last year ahead. It's gone super quickly, but great to be here.
We are not analysing what you said a year ago, Paul, but if we did, where would you come out?
I actually didn't have that great a year in terms of the currency outlook, particularly on sterling. I thought sterling would do a little bit better than it had. I can remember talking about how the Bank of England would cut interest rates only relatively cautiously, and I thought that would provide some support. I did talk about the risks around fiscal policy, but as we might talk about later on the pod, I think actually it's the UK's trade imbalance and weakness of growth rather than fiscal policy and interest rates. So I'd actually give myself about 4 out of 10, unfortunately.
4 out of 10?
I am a hard marker.
Two better, Paul. And also, down the line, Brian Daingerfield, the head of G10 FX strategy from the US.
Hey, how are you?
Good, thank you very much. Delighted to see you in your palatial corner office. I'm imagining that. Today, we are asking, what's next for foreign exchange in 2026? So, Brian, we're coming to you first because the firm opinion of the group was it's all about the dollar.
Yeah, I think that's right. 2026, as is often the case, feels like it's going to be all about the US dollar outlook and how that feeds into the rest of global currency markets, global risk appetite. So we're recording this with the Fed having delivered 2 25 basis point interest rate cuts, but at their October meeting, trying to pull a bit of optionality into the market, basically saying, hey, potential December cut is not a foregone conclusion. We still think that they end up delivering a rate cut in December, but the Fed tried to reintroduce some optionality into, I think, the pace of their interest rate cutting cycle, but we think the direction is still pretty clear towards lower interest rates. So just to put some numbers behind that, we think in addition to a 25 basis point rate cut delivered in December, we think we get an additional 75 basis points of easing in 2026, which brings the policy rate back towards a more neutral level. Now, I think if you look at market pricing where it is today versus our own outlook, there's maybe a difference in the speed and the pace of that delivery, where the market's version of that is maybe a bit more linear, that cuts come in a more sequenced base. Our own version is a little bit more backloaded, where those cuts are delivered on potentially under new Fed leadership in the second half of 2026. But we think what really matters is that the Fed is easing policy. They're going to continue to do so. Most of the major economies who had eased policy earlier look like they're closer to the end of those cycles. So we do think that we're going to get some interest rate convergence in the front end of the yield curve of the US relative to its peers, and that often tends to be an important driver of the dollar.
But if the Fed is easing in 2026, there is that potential for a policy mistake.
That possibility is always there. But I think if you look at our own growth expectations for the US economy, our own expectation is that growth weakness is really concentrated in, say, the fourth quarter of this year and into the first quarter of next year. As you get some of this Fed easing delivered, potentially some additional fiscal stimulus, the economy and maybe some inflation pressure might be starting to show some signs of rebounding in the second half of next year. But under different Fed leadership, it seems pretty clear that some of the appointees from the Trump administration may be angling more clearly towards bringing interest rates back to neutral. The emphasis coming from the administration, I think, is one to run the economy as hot as possible. We think that includes putting individuals at the Federal Reserve who are more open to moving policy rate back to neutral levels. That could include additional fiscal stimulus as well. Does that mean that a policy error is necessarily coming? Maybe, maybe not. But we do think that as part of this run the economy hot kind of mantra, that those are the types of things that tend to put downward pressure on the dollar as part of a broader loosening of financial conditions as this administration looks forward to 2026 midterms.
Paul, what are the implications for hedging US asset exposure?
those who need to hedge as the Fed cuts interest rates, those hedging costs fall. And also, I think it's also a function of whether people think that they should be hedging more than they have done previously because of some of the drama around US policy. So you mentioned about a possible policy mistake from the Fed, maybe pressure on the Fed to keep interest rates too low for too long against the backdrop of the economy. Undermining official institutions can play pretty badly. And that might just change the dollar's correlation with risk assets in the equity market. So, for example, we've traditionally been brought up with thinking as US equities fall, the dollar tends to rise. So those who own US assets, there's no need to hedge those assets because equities go down, dollar goes up. If you've hedged, you don't get that benefit from the dollar weakening. That seems to have changed now, where when equities go down, the dollar weakens, and people might decide that this is time to hedge those assets. Why it's important for global currency markets, who owns those US assets? And that's a function of which economies have run current account surpluses over the years. They've got their excess savings, they put those abroad. There's some economies that have done quite a lot of that over the years. Another way of saying that is just look at net investment positions of economies. Those that have more US assets have more assets to hedge. And those that have run current account deficits, net foreign asset positions are actually weaker, will have less need to hedge. And I think that plays out in some of the bilateral exchange rates, which currencies do better and which ones do less well if the dollar starts to weaken and people start to hedge.
I'd like to ask you, Brian, about this dollar reserve diversification trend. Is it going to accelerate in 26?
Yeah, we think there's a good case for de-dollarization to continue. The dollar share of reserve holdings has fallen pretty slowly but surely over the course of the last couple of decades, standing at around just over 50% of total allocated FX holdings are in dollars per IMF data. The dollar is still the number one reserve currency, but its role is still slowing. It's still reducing, albeit at a pretty slow pace. And so I think there's two questions around de-dollarization the market really should be asking themselves. The first is this reserve diversification story, which is ongoing, which I think is important. And then there's the other story about FX hedging, which Paul nicely covered off a moment ago, which is there's official institutions and their treatment of the dollar, and then there's international investors and their holding of US assets, whether that be fixed income or equity holdings. I think it's really important to think about whether the correlations between the dollar and some of its traditional drivers, we've seen some signs that those correlations have weakened in 2025. And I think FX hedging and change in the dollar's role as the global reserve currency, I think is a part of that story. So this is a really important one to watch in 2026. That's maybe above the general cyclical questions that we're always asking ourselves about growth and monetary policy. So this is a really important one to be watching.
There is so much drama at the moment in geopolitics. How does this play out in foreign exchange? Do the markets get caught up in this, or do they successfully manage to filter out that drama and stick to the fundamentals?
I think it's been a bit of a fade that FX markets in general have taken a look at, Russian incursions into Polish airspace, the prospects of NATO interference in the Russia-Ukraine war, and they've generally overlooked it. What they instead have looked at is very low market volatility, the fact that there's a general consensus the dollar is going to go lower US interest rates, and they've just come back into high carry trades. The easy money-making trade.
I think financial markets have learned that trying to play that drama that you quite rightly point out just hasn't been profitable. I think it was Einstein who said that the definition of madness is doing the same thing over and over again and expecting a different result. And I think markets have become tired that you've had this drama and it hasn't had the impact on FX rates. I mean, it's been quite remarkable at times, certainly around the Middle East, where you go away on Friday expecting something quite significant to happen. It happens, and you come in on Monday morning and markets are surprisingly becalmed. I mean, as an FX strategist, it's been quite frustrating. And I think what markets have done is they've moved on one step from just anticipating the impact on real economic variables, on growth, on commodity prices, on the oil price, on inflation, to actually waiting for the data to be published to see if it does have the impact that we think it might have on employment and on confidence, consumer spending, and therefore what central banks might respond. I think that's definitely been a theme this year of FX markets have come desensitized to drama about geopolitics.
So I'll bring it back to the US president, President Trump here, and just say, I feel like heading into 2026, Trump is a bit more of a known unknown rather than an unknown unknown. The big questions we had at this time last year about the president were the size, scope, and duration of tariffs, whether or not he would be able to pass the big, beautiful bill. Those questions have now been answered. And it feels like for markets, 2026 is less about what new policies that we'll get from the Trump side and more about what those impacts will be. And as Paul rightly pointed out, how they're actually feeding into consumption, how they're feeding into growth. I think it's right to say that the impact on inflation from tariffs has not been as uniform or felt as quickly than most expected. That's been, I would say, a surprise in the outlook. And also, let's call a spade here. One of the big surprises relative to Trump 1.0 is how the dollar has responded to all of this, that the dollar's response in 2025 was much different than it was during Trump 1.0. I think it's right to say that the market's day-to-day response to the volatility coming from the administration has probably fallen. But we shouldn't lose the fact that these have been very significant changes in the US approach, and those have meaningful implications for the dollar that we think are long lasting. And we just talked about a big one, which is foreign reserve status and FX hedging. Even if the day-to-day volatility has maybe come down, I still think the market's focus on these longer term issues does matter for FX.
So looking ahead to 2026, all three of you, I want you to give me some indicator that you're watching out for and that we should be watching out for as well. That's going to tell us a little bit about how things are going to go. Brian.
So for me, I think I'll come back first to just relative monetary policy. I feel like that is a first stopping point for foreign exchange, that if we are right that the Federal Reserve is going to be delivering interest rate cuts in 2026 while the rest of the G10, the outlook for monetary policy is a bit less exciting, then we're going to see some of that interest rate convergence. And I think a secondary question is, will this correlation, this once very strong correlation between relative interest rates and the dollar, start to reconnect a bit? Because in some pairs, we've had convergence in interest rate differentials, but we haven't seen corresponding dollar moves, say, for example, weakening dollar. Dollar yen's a really great example there. We need to be watching monetary policy. That's a first order impact for me. And also whether or not the past correlations, which suggest weaker dollar when you do get that interest rate convergence, if that starts to show some signs of reconnecting in 2026.
Eimear.
Yeah, I'm watching South Korea's Kospi index. So it's a very tech-heavy index, and all these concerns about AI overvaluation. I think that is the thing to watch. And I think there's a real risk that kind of negative equity market sentiment could spill over into the FX universe.
That is a great choice. Paul, what about you?
I was going to go with Brian, just that correlation between the dollar and yields, because if it's not yields driving the dollar, then you have to look elsewhere for alternative drivers. But beyond that, and this is an indicator I think transcends both the currency markets and bond markets and equity markets, the gold price, to what extent investors are moving away from fiat currencies, their willingness to hold dollars, euros and sterling, as it appears that the US administration has weaponized the dollar, and so have other central banks as well. And if the gold price continues to move higher, it's obviously had quite a significant correction, but it's had a very strong run over the past year. And if that extends, I think that that's going to be important information for currency markets in 2026.
We run the risk of talking about the dollar all the time. I'm not saying it wasn't fascinating, Brian, because it was, but we really ought to talk about the rest of the world as well. And if we're not talking about the dollar, what should we be talking about? Well, Eimear, what should we be talking about?
I think Brian has helped to outline that I look for a weaker dollar, lower market volatility, the prospect of lower rates and still reasonable growth really sets a positive environment for EM and high carry EM. So I think there's been a lot of investors basically pulling into high carry, high yielding EM currencies. And I would say there's probably a little bit of complacencies around the edges, that they're not really looking at the fundamentals, but they're looking where they can earn return.
What fundamentals should they be looking at?
But in my space, I'm always warning of political risk in Hungary. I think the Hungarian forint I think it's the 5th highest carry in tradable EM, and investors have been kind of long to the hill. But I think there's a risk going into a very highly contested election next year. You could get some political interference. And I would say always the risk in EM is that, there's a very small exit window. And if people are piled into that room, it's very hard to get out.
Paul, you mentioned current account surplus before. Tell me about how that figures.
That could be more important in the coming year than in previous years. One way is through that hedging that Brian set out. The question that Eimear, Brian and I get a lot is, well, what's the alternative to the dollar? And there we're looking for areas where growth could be strongest. And for some economies, they have large current account deficits that need to be funded. But if you get strong economic growth, then that will attract that money from the US into their economies. And I think there's a number of economies that can benefit from that. I think that could be a key focus here in the UK. I think the twin deficits are definitely important. On the other side of that, those areas that have current account surpluses, I think, can benefit from hedging flows. So you have this barbell that you could actually get some surprising moves driven by countries that have different current account surpluses. I think that will be an important theme for the coming year.
If there is this diversification away from the US dollar, does it naturally mean that the euro or the pound strengthens? Does it mechanically work like that?
Well, if we jump back to 1999 and the first sort of decade of the euro, you definitely saw that coming through. The amount of diversification that was being seen was relentlessly supporting the euro dollar, for example. So that's when euro dollar went up all the way to 160. And those flows matter, and they're also potentially large. If you have 14 trillion foreign exchange reserves and you get small changes in the percent allocated to particular currencies, I think it matters. And also, if you've got relatively small currencies, that even exacerbates that impact. And one of the themes that we've observed, especially over like the last 7 to 10 years, is FX reserves moving away from, say, traditional currencies where FX reserves were held to more sort of other, in the words of the IMF. And there you've got some emerging market currencies. You've got places like Norway and Sweden, although there's reasons for thinking that they don't attract the reserves that they did, say, back in 2014 with the euro area debt crisis, where they seem to benefit because there's just fewer assets there to buy. So I think where that money goes and into what asset will be the defining feature of FX markets in 2026.
Brian, I can imagine you probably roll your eyes when journalists like me start saying, is it all over for the dollar? Is there an heir to the dollar, or are we talking about balancing portfolios here?
There is no singular heir, although the euro is probably best positioned, because you have to think about where are there deep and open economies, large economies, free and fair capital markets. And the euro, and I mean, it bears out in the data, has been the currency that is probably the largest potential beneficiary. But if you think about things like geopolitics and those who are strategic adversaries of the US and potential use of alternative assets, whether that be gold, or you think about countries under sanction, for example, maybe more open to using other assets like the Chinese yuan, for example, in trade. And so I don't think there's any one currency that really stands as a perfect substitute. And I think that's part of the reason why the dollar's reserve currency status is really only eroding slowly rather than quickly. But small changes in this market make a massive difference, right? Over 10 trillion in allocated FX reserves. So a small change can make a big difference.
I think it's interesting what Brian was saying about the euro in particular, because the euro share of FX reserves, having moved higher quite significantly, has been really quite constant at around 20% of overall global reserves. And it was interesting what you were saying earlier in one of the questions about the drama about geopolitical outlook, some drama around the US outlook. And traditionally, the euro area has also had that political drama, debt crisis. But every crisis that the euro gets through, it makes it stronger. And when I look to 2026, I wonder whether it's the year where the euro comes of age, that it has less drama. And when we think about the impact of political risk in France and bond market volatility, But the resilience of the currency, I think that's just shown that the euro has improved as a candidate for risk assets. And maybe this is a time when it starts to see additional renewed inflows from FX reserves that it hasn't had over the last 10 years or so.
It's less than 15 years ago when we were speculating about countries abandoning the euro.
Yeah, and I think that that's really important because when you think about the French political risk, there isn't that debate that no one is talking about France leaving the euro or, importantly, contagion to somewhere like Italy. And Italy is then pushed out of the euro. That's not been the story. In fact, the story has been one of resilience of European debt markets. And again, it's the euro area ticks some of those boxes in terms of being an alternative to the dollar. As Brian said, not as the global reserve currency, but just a currency where you hold reserves because of this lack of drama. And it's a large liquid economy, and governments will be issuing more bonds, which has been one of the pushbacks on the euro, that you don't have the liquidity in bond markets. And that's steadily changing.
Yeah, I would have to back up and say the euro. I think another contender is potentially the Chinese yuan, but I would say there is limits to that. So yes, we have had an allowed appreciation of the Chinese currency over the last year, but it's actually appreciated less than other currencies against the dollar. So actually, it's been an opportunistic devaluation of the currency. And I think there is going to be limited will to invest in the currency when it's still heavily managed. And I would say the scope and the depth of the Chinese bond market is also going to stand against it. So I would say it is going to be the euro as the main beneficiary. We might see more inflows into the Chinese yuan and also things like gold, as Paul previously said.
We like to frame these things as a US-China competition. In this market, at least, that's not so.
You know, structurally, they're obviously very, very different.
Yeah.
The US has kind of become the world's debtor and obviously offers significantly big financial markets.
Paul, 12 months ago, I remember asking you for predictions. You know, I really wish that I had written down what those predictions were, because then we could talk about them specifically now. So I'm not going to make that mistake again. Everyone, get your pens out. I want Paul's predictions. This time next year, strength of the pound.
I think sterling does relatively well against a broadly weak dollar. So sterling dollar potentially into the high 130s. You never know, 140. Those holiday pounds will go a little bit further when you go away, or as my grandmother would say, sort of ice cream money. And I think that that will do relatively well. I think against other currencies, I'm less confident that sterling recovers. Over the last sort of 3 to 4 years, I always thought there was a peg to hang a recovery story for the currency. You might recall back in COVID, sterling had weakened very dramatically. People saw the UK economy being hit quite badly with service sector economy. Once we got a vaccine, the currency bounced back quite significantly. I thought that was quite clear. We then ran into the European energy crisis. The UK again was expected to have been hit really quite badly. We didn't have storage of energy. We didn't have long-term contracts. People were worried about the lights going off and the industry cutting down. But energy prices came down once we went through the winter without any due stress. And sterling rallied quite significantly, I think, because of current account flows. Last year, I thought it was going to be this idea the Bank of England kept interest rates high for longer. Traditionally, carry has been important for sterling. It didn't quite pan out that way. It started off quite well, but I think what happened for sterling through the year is people became more downbeat on economic prospects. And this is why the focus on current account surpluses and deficits is important. The UK needs to attract capital abroad. We need to pay the bills. Where does that money come from? Unless the economy starts to pick up, and I think you need productivity growth, you need inflation-free growth, it could be quite a challenging year for the currency. So I think something's going to have to change if sterling is going to outperform non-dollar currencies in 2026.
Brian, while we're playing a prediction game, are you prepared to do the same for the dollar?
We have the dollar broadly lower as a reflection of not only changes in relative monetary policy, but also shifts, as mentioned, in dollar exceptionalism and in foreign investor approach to hedging the dollar exposure of their equity and fixed income holdings. And so we think that there's a clear picture here for some dollar underperformance as these different potential drivers converge on convergence, sort of pointing in the direction of a weaker dollar in 2026.
So in our final section, I would like each of you to tell me something that maybe people listening to this haven't thought about quite so much, but something that keeps you awake at night at the moment. Brian, you start.
For me, the big one that I think about is if we're heading towards some form of fiscal monetary coordination in the United States under new Fed leadership. So think about something like Treasury Secretary Scott Bessent working more in tandem with the Federal Reserve. That could include fiscal stimulus in the US that's effectively partly funded by Federal Reserve, say something like quantitative easing coming back into the picture. We know that the Treasury Secretary in the US has been very focused on keeping long-term yields lower. Now, that's not our rates forecast, but that is something that I worry a bit about as maybe a longer-term challenge, is that when you get this coordination between more expansive fiscal policy that's offset by looser monetary policy, that often is a combination that is negative for the currency. So that's something that may be a low probability event, but something that certainly keeps me up at night as I think about the long-term picture for the dollar.
Paul.
Geopolitical events. I know that we said that global currency markets had become desensitized, but I do worry about the borders of Europe, Russia, Ukraine, the Baltic states, and the read across to Asia with China as well. So I wonder whether we go into 2026 being complacent about these risks. Just because they're dogs that haven't barked doesn't mean they don't bark in 2026. That worries me, because I think there is a window for escalation in some of these conflicts in these regions of the world. And that's definitely what keeps me up at night.
Keeps a lot of people up at night at the moment, and not just about FX. Eimear.
Paul stole mine. I was going to go with geopolitical risk. But I will pivot back to my previous key indicator to watch, which was the Kospi index.
Yep.
So I am worried about very lofty valuations in equity indices and just the potential that future earnings won't match up to these potential valuations, and just the risk that could really spill over into FX and bond markets. That's the one I'm watching.
I think Eimear makes an excellent point there when we think about risks to the outlook, that you go into 2026 with risk assets doing extremely well, but then you have to pay for that in some way, and that actually interest rates don't come down as quickly as expected. By the end of the year, we're having to raise interest rates for a world that is heavily leveraged. So I think that's a very important way to look at it.
Thank you very much. Paul, are you related to the Paul Robson on the Bondcast podcast?
Yes, I am actually. I've been trying to get paid twice for pretending that I'm a currency strategist and a rate strategist, but yes.
You're getting away with it very well, Paul. Thank you very much.
Thank you very much.
Brian, thank you very much.
Thanks for having me. Look forward to hopefully an eventful 2026.
I'm sure it will be eventful. And Eimear, thank you as well.
Cool. Thanks for having me.
Thank you to all of you for listening. Please keep tuning into Currency Exchange. Follow us as well. Leave us a review too. See you soon.